Good morning, everybody, and welcome to our quarterly roundup for our Nedgroup Investments Global Suite of Funds. My name is David Levinson, and I have the pleasure of hosting you today as we traverse the world of global markets from quality and value equities into property, physical assets, emerging markets, developed markets, and bond markets, of course. Not quite fully as far as 180 days, but we do appreciate having your ears for the next 120 minutes. As we hear from our managers and hear what's happening on the ground and how the funds have performed during the second quarter. And what better place to start, as we usually do, with David Roberts joining us online from the UK. David, thanks as always.
No problem, David. Good to be with you. Good to talk with everyone again.
Now, David, I used to be an equity guy, and I've fallen into the trap of the cliche is that that's where all the excitement is. But I appear I stand to be corrected. It's been quite a fascinating month, or quarter at least, for the bond markets, which have actually performed relatively well.
Yeah, it's been good, David. I mean, I think we need to be honest here that there is a single driver for global bonds at the moment, and that is oil and everything associated with it. But as you see, the second quarter of the year was a good one. I mean, if we look at our fund, if you annualize the return, then we're up around 9%, so over 2% for the quarter. And just a little under 1% ahead of the underlying index, the global aggregate ex China. So there's been a nice positive return, certainly for the second quarter of the year after what was quite a flat first quarter. So really, as I say, it's been, as we'd say here in the UK, a one-trick pony where the only real thing that's mattered has been trying to understand the direction of oil and associated geopolitics, David.
Thanks very much, David. I mean, your next slide speaks to how bond markets, or what it looks like, at least over the last, since 2020. So going into COVID, I guess, and what a stark contrast we have today to the world we were seeing back then. What does this mean from an investor perspective? What are we actually looking at here?
I think that's a really good point, David. So on slide 3 in the presentation, so we look at the what's happened in bond markets over the last 5 years, as you say, and really we'd come out of that QE period and then the period where governments around the world basically tried to stave off any form of recession by throwing money at various crises, including COVID, as you say. So what's really happened is, I would say, is monetary policy across pretty much all of the globe has normalized. There's a couple of places in like Japan where it's still been worked through. But what that's really done is seen yields rise from very low levels that weren't offering anything, I don't think, for investors, to levels today that are, certainly in G10 terms, likely to provide a base case for consistent outperformance against inflation. I guess just maybe before we move on to look at a couple of other things, a really important point, I think, that my co-manager Alex Ralph and I have made since we launched the fund is that there's a lot of noise, a lot of volatility in the short term. But as you can see from that chart on slide 3, if we just use US 10-year yields, which are a kind of global benchmark, if we look at them, then really since the initial sell-off post-COVID, since interest rates started to be raised, they've been quite stable. You know, they've whipped around a lot, yes, but compared with what we saw 21, 22, 2023 to 2026 have been actually quite stable. So that's been a really nice base, David. And I think generally, if we look at the level of yield that's being offered at the moment, that's a good entry point, in my opinion, to start to build long-term returns for fixed income investors. So yeah, things have changed, but I would say for those who are now looking at the market or who are invested, in a pretty positive way.
Thanks, David. Yeah, very interesting to track those treasury rates. I was actually quite surprised to see where they were, and at least how stable they've actually been of late. Maybe going back to my previous comment about being an equity guy, I think your next slide is the one that converted me, or at least is in the process of converting me into a bond guy. A lot of movement. Looks a little bit like a minor roller coaster there, but what's fascinating is how the fund has navigated all these different market moves that we've seen. What has been the key, or at least the secret sauce to that sort of consistency?
Well, yeah, so the slide 4 in the presentation. So what this is, I think you've already made that point, David, that when we look at bonds, a hugely important part of bond investment is the point that you initially invest at. So what we tend to describe that is the level of income, the level of yield that's going to be generated. So almost like the natural return on your portfolio without the fund manager doing anything particularly special and not needing any kind of market rally. So most people, when they worry about bonds, they say, "Oh, well, I think yields might go up," and then they'll give you 10 reasons why that could be. And what they don't often focus on is the starting point. So the point of this chart is we launched our fund in January 2024. Since then, the white line, so that's the yield again in 10-year treasuries, has actually moved up slightly. So yields have risen. So normally, if you talk to various people, if you read older textbooks, they'll say, well, that's bad. And it is true that eats a little into the total return, into the capital return. So for people who owned 10-year treasuries for the last 3 years, they've seen a small degree of capital loss. But they started off with a yield of 4%. So 4% over, say, 2.5 years, that makes you 10%. So the income is very, very important, and that's highlighted by the yellow line, which is our portfolio return. So in the scale on the left-hand side of your chart, so we launched at a price of £1, and when we snapped this toward the end of June, the portfolio was up 14-15% in US dollars after fees. Most of that, as I say, coming from income, and then obviously another 4 or 5% over that period from what we've been able to add as fund managers. So very important again. Starting point matters. Don't be worried about smaller moves in interest rates in an upward or downward direction. That core level of income that a bond fund such as this should provide can be, I think, a valid, you mentioned equity a couple of times, a valid start, a valid foundation for a broader investment portfolio, perhaps something that allows investors a little bit more comfort and, dare I say, sleep, the ability to sleep easier at night. So yeah, I think starting point, very important. And as I say, with yields where they are at the moment, that bodes well, I think, for the future, David.
I know in our conversations in the past, a healthy bit of volatility offers a nice entry point to take advantage of those sort of opportunities. But we focused a little bit looking backwards. I'd like to put our forward-thinking cap on here. What are the key themes that you'll be looking at quite closely as we move into the third quarter? I know you have some interesting comments around the macro and the micro environment, and of course geopolitics rears its head.
Yeah, so again, on slide 5, we've got a kind of bullet point summary of the outlook. I mean, we tend to, again, as you know, David, we look at 2 or 3 the market in different ways. We'd say we segment the drivers of markets. We have macro, micro, and then the political situation. It's almost in reverse at the moment. Politics, is conflict political? We can discuss that type of stuff all day long, but as we enter the third quarter, what we continue to see is uncertainty about geopolitics. We've deliberately kind of avoided oil in the 5 or 6 things we put down there. We'll assume oil is a given. We're starting the quarter with oil having come off its highs, but with some signs that this conflict is continuing. So that's never far from our minds. I would say that as we move through the third quarter, though, now just to run through those very briefly, US midterms again. We're already hearing noises from the US about the political situation and how that could evolve as we come through to the midterm elections, and the possibility that the Republicans lose control of 1 or 2 houses. The next thing we said, a Liz Truss moment, that really refers to UK politics. The UK recently elected a new Prime Minister. We're still waiting to see how that plays out. The UK, although we're based in the UK, it's a very small part of our fund in the global market. Probably more an opportunity than a threat for our investors, but certainly one worth following. Canada seems to have moved toward China. We're zero weighted to Canada at the moment. This is, again, not a big part of our market. And then in the other 2 major parts of the market we look at, France is, bonds relative to Italian bonds, for example, are about as cheap as they've ever been, but partly because of lots of political pressure and fiscal pressure there. So just stuff going on all around the globe, David, that we think we can take advantage of. Opportunity, probably more than threat, I would say, from our perspective. And then the stuff on the left-hand side of the slide. So we continue to see a small degree of monetary policy divergence. So the market over the course of the second quarter moved from expecting rate cuts to expecting rate hikes. That's part of the reason why yields are just slightly higher than they have been. And there's still an awful lot of uncertainty at a macro level about what Donald Trump's going to do next. I think we just have to accept that. And as I say, the way that we're managing that, and we'll maybe see in the next slide in terms of positioning, but the way that we're managing that type of uncertainty is stay reasonably close to what we think investors expect of our portfolio. And then if we see opportunity created by those, when politics interferes with macroeconomics, that's when we start to take advantage. I would say very briefly then on the bottom up, so micro opportunities. Companies continue to post pretty strong earnings, but we are, I would say, somewhat nervous of two main things. The first is private credit. So it's been well discussed in many other places, but that doesn't really impact us immediately or directly. Rather, it has the potential to fall out and move into the corporate bond world. So we're conscious of that in our portfolio positioning. And then lastly, one thing that you and I have talked about previously, not just, well, there's all sorts of reasons to be slightly nervous about AI, but for the bond market, the biggest reason to be nervous, I think, is that we are being asked to fund excess growth, which normally that's not what bond markets or bond investors are expecting. So we've seen about year to date about $500 billion of bonds issued by companies from Meta through Amazon to SpaceX, all of which are kind of aimed at AI. To us, those are too speculative. So at the moment, we're steering clear of all of those. As the quarter ended, bonds issued by that type of entity have generally performed quite poorly. At some point, we might start to look at it as a value opportunity, but just at the moment, as I say, for us, David, AI is something in terms of bond investment we believe should be avoided.
Thanks, David. I mean, there's quite a lot to unpack here, but I do have one question. I was reading last week President Trump blaming Carney for the air from the wildfires in Canada starting to affect the air quality in the US, which has had a tinge of irony behind that. But Carney's predecessor, Trudeau, maybe wasn't as calm ahead, but there was an interesting thing a couple of years ago, some tension between him and Xi in China and certain politically connected Chinese people in Canada. So your comment there about Canada loves China stood out a little bit for me. What does it actually mean? Because we didn't really unpack that too much.
So what we're seeing as the relationship between the US and Canada deteriorates, and at the time of this recording, we're just hearing that Trump's starting to put through some more tariffs on Canadian goods. So as that relationship deteriorates, we've heard all about Trump thinks Canada should be the 51st state. I think it's only logical that Canada seeks, I would say, primarily business partners rather than necessarily political partners in other parts of the world. So if they can find a home for some of their goods, or if they can bypass some of the levies that Trump's talking about imposing and maintain their industry, then fine. I think your point on wildfires is very, very well made. The Canadians and the US have a long history of collaboration. I mean, obviously, a fire is no respecter of a border. Neither is smoke nor wind direction, and there is, as you say, there's more than a tinge of irony that one of the biggest polluters on the planet, namely the US, which arguably is responsible for a degree of the issues that we're seeing in terms of the prevalence of fires in Canada, is now saying, hey, you Canadians are bad people. But as I say, over the last decade, what we've seen is a lot of support. Californian wildfires a couple of years ago, which sadly claimed a lot of lives. And the Canadians were very quick to support the Americans in their efforts in that area. So it feels a bit political. It feels another thing that, really, if we step back and just think what's good for North America, then it should be an attempt to address the situation, I would say, in a collegiate fashion rather than the way they're doing it at the moment. What it means for us, again, is that Canada's about 5% of our index. Canadian bonds look very, very expensive for a number of reasons relative to other markets. So again, it just creates an opportunity, David, for us to take advantage, perhaps, of that intersection between politics and economics. As you're not suggesting Canada's about to fall into bed with China necessarily, but certainly it's a logical, sensible thing as some of these traditional relationships come under pressure. For parties such as Canada to seek other partners.
Thanks, David. I think that's what we appreciate from you and the team, is ability to see the wood for the trees and not get caught up in too much of the petty politics and commentary that we see today. And I mean, against that sort of backdrop, what are the main sort of key features and themes you'd want the audience to take away? I know 15 minutes is a wicked task to get that across. So what do you want them to take away from today's discussion, and what to expect from the fund and how it's positioned?
I mean, if we just, our final slide really is slide 6, so it's portfolio positioning. For anyone who looked at that over the course of the last quarter or so, they'd probably see that there hasn't been a big change, David. And I think that's quite important. Why is it important to say we haven't changed much? Well, total return and also relative return to our underlying index have been quite strong. Where we are at the moment is we think these are good long-term opportunities for our clients. We think that the overall level of yields will provide strong total return, or at the base for strong total returns. So strategically, we like the market. But I think to your point, that's the starting point. For the long term, we think now is nice. However, in the shorter term, what we've been doing and what we think we'll have to continue to do is really sweat the portfolio to look for myriad small opportunities rather than, in cricketing parlance, it's like instead of sort of swinging for the boundary and looking for a 6 off every ball, it's trying to find the cheeky single, and be nimble between the wickets. So it's that type of stuff that we think, well, it certainly has benefited our investors in our portfolio return in the second quarter. And because we're almost at the mercy of the next tweet or, the next comment on social media from, half a dozen people globally, it's difficult to sometimes, as you say, to stick to your process and your portfolio guidelines when the world around you seems to be changing every 5 minutes. But what that earlier chart showed is that actually bond yields have been quite stable. The total return available to bond investors, even going back 2 or 3 years, was quite high. Today, I think the outlook is more positive. I think it's important. I mean, the last thing I would finish on is just for our portfolio, and I think every portfolio in your range is designed for the medium to long term. And I think, sometimes you just have to look through that short-term noise, try to take advantage of it if you can, but be patient. And in the medium to long term, sound process, sound investment philosophy will normally win out.
Thanks very much, David. There's obviously that saying that when the US sneezes, the rest of the world catches a cold. We have our emerging markets team next up, and I think you've distilled a lot of the sneezing that's happening. And so plenty of cold going around. But the way that you've articulated that, I think we've got a great understanding. And your slide, I think it was slide 3 around the performance of the fund against the bond market movements, I think is a wonderful illustration for anyone invested in the fund to see what their journey looks like and the stability that you and the team have created. So thanks as always for your time today, and we look forward to catching up with you in 3 months' time to see how Q3 went along.
Great. Thank you, David. Thank you, everyone.